Hi guys, and welcome back to the Mindful Investing channel. Facebook is almost down 50% year to date. So let's have a look at Facebook, value the company, and try to assess the returns Facebook would offer us if we were to invest right now. As always, we'll value Facebook using our simple discounted cash flow model. To be able to value Facebook using this simple DCF, we have to first make a couple of assumptions. First, we have to assume Facebook's expected free cash flow growth rates for the next 5 years and for the 5 years following those 5 years. Then we have to assume Facebook's price to free cash flow multiple at the end of our holding period, so basically in 10 years. And lastly, we have to assume Facebook's buyback yield over our holding period. So let's begin with our assumptions for Facebook's free cash flow growth rates. Personally, I like to base my free cash flow growth rate assumptions on Facebook's historical free cash flow growth rates. When we calculate Facebook's compound annual growth rate for its free cash flows based on the last 4 years, we come up with an annual growth rate of roughly 22.3%. To be extremely conservative and to show how cheaply Facebook currently is valued, I only assumed a free cash flow growth rate for the next 5 years of 8%, and for the 5 years following those 5 years of 5%. Next, we have to assume Facebook's price to free cash flow multiple at the end of a holding period, so basically in 10 years. Because I think that Facebook is a high quality business and to reflect our assumed free cash flow growth rates, I assumed a price to free cash flow multiple in 10 years of 15. Next, we have to assume Facebook's annual buyback yield over a holding period. Like with our growth rate assumptions, I personally like to base my buyback yield assumptions on Facebook's historical buyback yield. When we calculate Facebook's annual buyback yield based on the last 5 years, we come up with an annual buyback yield of roughly 0.46%. To be conservative, I only assumed a future buyback yield of 0.4%, even though Facebook already increased its buyback to take advantage of the depressed stock price. Because we assumed Facebook's free cash flows to the whole company, which is usually funded by debt and equity, which bear different costs, we have to reflect those cost differences in our discount rate. To do so in our simplified DCF, we simply enter Facebook's current market cap, its interest-bearing debt, and its interest expenses. After doing so, we can finally calculate our expected internal rate of return based on our assumptions by simply adjusting the cost of equity until the number in the green box is equal to Facebook's current enterprise value per share. When we do so, we come up with an IRR of roughly 17.1%. So even based on our, in my opinion, conservative assumptions, Facebook still seems like an interesting investment. So that's it for today's video. If you have any questions, don't mind leaving a comment, and if you enjoyed the video, please leave a like. As always, please remember to do your own due diligence, your own research, and to never simply trust a guy on the internet telling you that there might be a potential investment opportunity. See you next time.